You who may not. Welcome back to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really happy to have with me once again John Rubino. John is very well known on this show. He's been on a number of times. We just mentioned that for those of you who may not be familiar with him, go to dollarcollapse.com to pick up John's work and links to a lot of other great sites and great articles. I mean, John handpicks articles that he thinks are very important and need to be out there and spread out to the public as much as he can. And so he's also the author of a couple of great books that he co-authored, a couple of them with James Turk. And so welcome, John. It's really good to have you with me again.
Hey, Jay. Good to talk to you again.
You know, mentioning James Turk, you and James co-authored a book in the past, and one of our listeners sent in an email, and he wanted to know if I might get your opinion on BitGold as and gold money as a way to own gold. I responded to the listener saying that, well, you're not that involved with BitGold, if at all. But of course, James Turk is, and we'll have James on our show sometime, hopefully in the not too distant future. But do you have any thoughts about BitGold and its capabilities of providing and maybe remonetizing gold?
Well, I love the concept of bringing gold into the modern monetary system. Because, we have the technology now, at least in theory, to turn gold back into a currency that trades and that is portable. And that's huge if it can work. And that's what gold money is attempting. And I'm not technically well enough versed in what they're doing to have a good opinion about whether they'll succeed or not. But it looks like so far so good. They're drawing a lot of customer attention. They're managing quite a bit of money now, and they seem to be ramping up without any kind of technical glitches. So I think their first year in operation is really promising. And if they can live up to their ideals, if they can manage the system the way they're intending to, then you will end up with, for instance, a debit card that you can take with you when you travel around the world and use to convert the gold in a bank vault that they're managing for you into local currency wherever you are. And that's huge, because one of the big problems with owning physical gold is that it's pretty hard to take with you when you go somewhere. It sits where it is, and there's a risk inherent in you leaving it in one place and going to another place, and it doesn't allow you to move it with you. If you decide you want to leave a country for whatever reason, because the country's becoming financially and politically unstable, for instance, it's really hard to take a lot of gold bullion with you. But if you've got a gold money account that is linked to your debit card, you take the debit card with you, and basically you're taking your gold with you, in theory. And so it'll be interesting to see in the years ahead if this works out in practice. And as I said, I think so far the start is very promising.
Yeah, indeed. In fact, I have in my hands right now a Gold Money MasterCard. It's a debit card that has worked. I had some issues at gas pumps in various places, but the last I tried to use it, it worked. And the way it works is you have your gold account that, and the value of that gold account changes with the price of gold. Then at any time when you want to sell some gold and turn it into dollars, you do that and put it into your Gold Money MasterCard or BitGold MasterCard debit account. And then you can take it to a store and buy things. And I've used it, so it actually does work. I know it works. I'm not sure that it works as well as I'd like it to yet, because it had some glitches. But it is very interesting. So I just want to get your thoughts on that, John. And thank you for that. I'd like to turn to some of the topics that you've featured on your Dollar Collapse website. One that you put out there: why interest rates can't go much lower. And you posted 5 charts: the Japanese GDP chart, Japan inflation rate chart. You showed the EU GDP growth rate and the EU inflation rate, and then the Deutsche Bank share price chart, which is going down very dramatically, or has over the last year or so, last number of months anyway, reflecting a substantial decline in the profits of Deutsche Bank. Well, help us understand. I mean, we were just talking to Michael Oliver, whose technical work is suggesting very certainly, in his view, and he has been so spot on so many markets, very certainly that we are seeing the end or a blow-off phase. We may have actually seen, he thinks, a peak in the T-bond rate. But tell us why, from a fundamental point of view, tell us why you think we can't go much lower in interest rates.
Well, if you look at the first four charts that you mentioned, Jay, that was basically the economic statistics from Japan and Europe, where interest rates are negative almost across the board.
Yeah.
It hasn't worked. Their economies are kind of flatlining, or in Japan's case, dropping back into deflation.
Yeah.
So clearly, negative interest rates didn't ignite the rip-roaring boom that Keynesian economic theory says should happen. And so mainstream economists basically look at that and say, well, let's just do more. If negative 1% doesn't work, let's do negative 5% or whatever.
Yeah.
But at the same time this is happening, the big financial institutions like banks, insurance companies, pension funds, and money market funds, and individual savers are all being crushed by negative interest rates. There was just a story about Japanese banks that came out last week that said the big Japanese bank profits are now almost $3 billion a year lower than they would be otherwise in a normal interest rate environment.
Wow.
And pushing interest rates down further will hurt the banks even more. And the Deutsche Bank price chart kind of illustrates the damage that's being done. Deutsche Bank was $53 a share in 2014. Now it's $14 a share. And this is Europe's biggest, strongest bank, supposedly. Yes. So there's apparently a limit to how low interest rates can go without blowing up most of the financial sector, because you can't run a pension fund if your entire fixed income portfolio is earning you nothing or less than nothing. Same thing with an insurance company. And if you're an individual, you can't save for retirement and you can't be retired if the safe stuff that used to generate you a reasonable income now costs you money to invest in. So we're perverting the financial system by lowering interest rates to this point. And I'm not saying we won't try some new monetary experiment, but I am saying that it seems that the unintended consequences, the negative effects of negative interest rates are beginning to loom very large. And so probably what we'll do next is some variation of the debt jubilee, in which governments just create a whole bunch of new currency and give it to people in some way, either through some big infrastructure program or tax cuts or just direct purchases of individuals' assets. Maybe they buy your house for twice its market value, something like that. And that doesn't rely on interest rates and therefore might not hurt the banks. And so it might be more politically palatable for the people who actually run the government, which is to say the big finance people, the 1% who run the big banks, who own the favored accounts at the big banks. They're kind of tired of negative interest rates. And since in a lot of cases they're in charge of national governments, or at least they're staffing the important positions in the Treasury Department of most national governments.
Goldman Sachs.
Yeah. You got to figure that the U.S. government, which normally does what Goldman Sachs and J.P. Morgan Chase wants, will do so in the future, because they literally own the Fed. The big banks own the Fed. People don't realize that the Fed isn't a government institution. It's actually a private sector entity that is owned by a consortium of big banks. And so it's no surprise that they do what their bosses want. And increasingly, their bosses want higher interest rates, or at least not a continued decline in interest rates. So if rates continue to go down, that's the market overriding the will of the big players in the financial markets, which will be very interesting. And it could happen, but there's already $13 trillion of negative yield debt floating around the world. And there might actually even be more than that when you consider that for a Japanese investor or a European investor to buy treasury bonds, normally they buy the bonds and then they hedge the currency risk that comes with buying a bond that pays you in a different currency. And when you include the hedging costs, U.S. Treasuries have negative yields for those investors now too.
Wow.
So that might increase the actual amount of negative yield debt in the world. And you know, it's hard to see how much further we can go into the tens of trillions of dollars. So,
well, it's very interesting. I noticed this morning that Dudley at the New York Fed, and he's been talking up this notion of higher rates. And yet, John, you know, whenever they start to talk higher rates, it has a negative impact on the equity market. So people are screaming and hollering about the declining value of their stocks. So we have a tug and a pull here, don't we? It's not one side or the other. And if I look at explaining maybe to our listeners why such low rates are bad for banks, and I think this is my understanding of it. Banks, they tend to borrow short term and lend long term, and if the long end of the yield curve is coming down, and if the short end is negative and the long end is virtually almost negative or very skimpy on the positive side, then there's no margin there left for the banks, right?
Well, and that's what's happening to the banks, among other things. But one of the things that's happening is that the money they make on a given loan is shrinking.
Right.
But it also means that, see, when you distort the financial markets by manipulating every major asset class the way the governments of the world are doing now, it makes it harder for the big banks' trading desks to make any money. And that's where the big profits used to come from for Goldman Sachs and to an extent JP Morgan Chase. They would set up trading desks that basically, you know, place a bet on something, and then somebody else from the trading desk moves the market towards the original bet, and they make money that way. In other words, they manipulate the markets. But if you have governments coming in and indiscriminately manipulating markets by, for instance, having central banks buy equities across the board, which is what they're doing now, you make it harder for the big banks. In other words, you have a bigger predator in the market, and so the smaller predators at the commercial banks can't manipulate their markets as easily as they used to, and so they don't make money. And so the big banks don't have any way to make money now. You know, investment banking's not going so well. Lending certainly isn't. Trading is a loss-making proposition now for a lot of them, and so they're in grave danger, and they're having to shrink. You know, Deutsche Bank, to go back to that example, is laying people off right and left, taking massive losses with every earnings report, and shrinking. They're completely eliminating certain lines of business, and they're turning into a smaller entity because they can't function as a financial supermarket anymore. And I think it's true for most of the big banks now, and that's a very big deal because finance has become so dominant in the global economy.
Right.
And finance is the most important industry, and it's shrinking. It makes it hard for the global economy to grow because what's left? You know, is oil or something like that going to take up the slack with banking? And that's not going to happen. So it's hard to see where we generate growth if the big finance entities are shrinking and energy is, if not shrinking, not growing anymore. You know, what is left? Really, retailing? That's not
that's not very promising either because everybody's broke and they've pretty much have maxed out to a great extent. Well, it seems to me, I mean, if you're talking about a debt jubilee, I think is the terminology, or the notion of debt forgiveness, I guess, and what you're saying is politically more palatable way might be helicopter money, printing money and sending it to the masses, huh?
Yeah, well, you know, these are all terms for basically the same thing, which, as you said, is creating new currency and giving it to people. It's another term for it is QE for the people. Yeah. And they all mean largely the same thing. The details of how they do it might vary from country to country. You know, some countries are talking about a guaranteed individual income where they give you 8,000 euros a year if you're in Europe. Yeah. Or 5,000 Swiss francs or something like that, which is basically, that's what it is. You know, they're giving you money and you can, if you want to, pay off your debts or spend it, which is what the Keynesian economists would love. You know, they'd love you to spend that money and then borrow some more money against your future guaranteed government income and spend that. And the downside of this is pretty obvious, which is that we'd be creating huge amounts of new currency. And supply and demand 101 says that with an increase in supply of that magnitude, you got to have a commensurate decrease in value. Mm-hmm. And so we end up destroying the value of our currencies, which, check this out, Jay, here's where it gets really interesting. If you're a rational actor in finance and somebody, the government announces that they're going to do this, and you understand that it's going to make the currency less valuable year after year, what's your rational response? It's to borrow as much money as possible, right?
Sure,
because you're going to be paying it back in cheaper currency.
Sure. And
so you end up, in trying to do a debt jubilee that eliminates debt, you end up increasing the amount of debt in the system by encouraging everybody who can borrow to borrow.
Right.
And so you get the blow-off phase of this 70-year-long credit bubble, which ends with a crash that is unlike anything we've ever seen before, because we already have more debt per capita and more debt nominally, in gross numbers, than we had in 1929 by far. We're much more indebted now than we were before the Great Depression. And so when this thing blows up, all bets are off. There's going to be no way to predict what happens exactly, except it's going to be crazy. It's going to be incredibly painful for the average person, obviously, because they're the ones who always suffer from government financial mismanagement. But I think it's going to be bad for a lot of other people who think they're going to get through this in good shape, too. What we're seeing now with hedge funds is an interesting example of that. Hedge funds.
Yeah, what are they doing? They're having a hard time making money.
They are. They can't figure out these
smartest guys
markets.
on Wall Street. Yeah.
Yes. Yeah. They've generally been considered to be the smartest guys in the finance world, the hedge fund managers. And one after another, they're reporting terrible numbers. And then the clients, the pension funds and the university endowments and the big foundations are pulling their money out of these hedge funds, and they're having to lay people off and in some cases close down big brand name hedge funds because these guys cannot figure out these markets. So it's highly likely that a lot of people who think they're bulletproof because they've got the smartest advisors working for them and they're paying them, 2% a year on their money and 20% of the profits, huge fees for brilliant, supernaturally brilliant financial advice. They're going to get burned too.
Well, John, we're just about out of time here, but I just have to make note of Bill Gross's remarks about a week ago or so. And I'm sure you've seen this, and heard what he had to say. I mean, I believe he said something to the effect that he doesn't want to buy stocks or bonds, and he's suggesting that we should buy the things that the Fed has not yet bought, like gold and land, huh?
Yes, absolutely.
I mean, well, you don't get anybody smarter than Bill Gross. Anybody more mainstream than Bill Gross, essentially saying the system is so screwed up that you better get out of it and buy gold and tangibles, huh? Yeah.
And he is joining a long list of heavy hitters who are saying the same thing. I mean, George Soros loaded up on gold a year ago, and Carl Icahn. These guys who are basically free to buy anything.
Yeah.
And have no problem going very long when the situation is appropriate. Now they're going defensive. They're going risk off in a big way. And I think we should pay attention to what these guys...
I think we should pay attention to what the smart guys are saying. And of course, you and James Turk and a lot of other guests on our show have been early on saying that we need to start doing that. But now when you see the likes of those mainstream guys saying it, I think you really have to take note. The time is probably very near in which we're going to have a lot of chaos, unfortunately. But it is what it is, and we want to plan as best we can. John, we are basically out of time now. I want to thank you very much for being with us, and never enough time with you. We'll have you back again sometime in the near future, all right?
Great. Thanks, Jay. To turn gold back into a currency that trades and that is portable. And that's huge if it can work. And that's what gold money is attempting. And I'm not technically well enough versed in what they're doing to have a good opinion about whether they'll succeed or not. But it looks like so far so good. They're drawing a lot of customer attention. They're managing quite a bit of money now, and they seem to be ramping up without any kind of technical glitches.
You who may not. Welcome back to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really happy to have with me once again John Rubino, John is very well known on this show. He's been on a number of times. We just mentioned that for those of you who may not be familiar with him, go to dollarcollapse.com to pick up John's work and links to a lot of other great sites and great articles. I think John handpicks articles that he thinks are very important and need to be out there and spread out to the public as much as he can.
So I think their first year in operation is really promising. And if they can live up to their ideals, if they can manage the system the way they're intending to, then you will end up with, for instance, a debit card that you can take with you when you travel around the world and use to convert the gold in a bank vault that they're managing for you into local currency wherever you are. And that's huge, because one of the big problems with owning physical gold is that
I responded to the listener saying that, well, you're not that involved with BitGold, if at all. But of course, James Turk is, and we'll have James on our show sometime, hopefully in the not too distant future. But do you have any thoughts about BitGold and its capabilities of providing and maybe remonetizing gold?
Well, I love the concept of bringing gold into the modern monetary system, because we have the technology now, at least in theory.
And so he's also the author of a couple of great books that he co-authored, a couple of them with James Turk. And so welcome, John. It's really good to have you with me again.
Hey, Jay. Good to talk to you again.
Mentioning James Turk, you and James co-authored a book in the past, and one of our listeners sent in an email, and he wanted to know if I might get your opinion on BitGold and gold money as a way to own gold.